Okay, good evening. Right, so as usual, if you have any questions, please voice it out on the chat box. Okay, today we are talking about chapter 16 on debt policy. All right, so I hope that you have your questions with you. Okay, today is actually a very simple topic. You will be covering on WACC, on the proposition, which is the Modigliani-Miller propositions. Again, I don't know whether the way I pronounce it correct or not, but the propositions. All right, the propositions. So let's go through the brief introduction to today. Okay, as you all know, the proposition is separated into two sections. There are two propositions. Propositions, MM1, the first propositions, value of a levered firm is equals to the value of an unlevered firm. The second proposition is basically based on your cost of equity. Cost of equity equals to required rate return of your assets plus debt over equity times with R0 minus cost of debt. Okay, this is the proposition without taxes. If it's come with taxes, it's in red color. So the red color here is tax multiplied by debt. Okay, or tax multiplied by borrowing. So here 1 minus T. Okay, so if it's with taxes, you need to include the red color section. If without taxes, it's only the black formula. All right, this is the proposition that we will talk about today, roughly. Again, in one of the debt policy. So let's look at question 12 now. So question 12 here, they're telling us Western industry has a debt equity ratios of 1.5. Okay, the debt to equity ratios of 1.5 means these are further elaborate debt 1.5, equity 1, total 2.5. Okay, its WACC is 11%, and its cost of debt RD is 0.07, corporate tax at 0.35. These are information given to you in the question. Of course, this is further derived. Okay, initially is given this only. All right, so look at A. They ask us what is the Western cost of equity capital. So basically, they want us to find the cost of equity. Okay, how to find the cost of equity here? So the information given is only WACC, cost of debt, and of course the weightage here. So as you know, WACC is equals to weightage of equity multiplied by cost of equity plus weightage of debt multiplied by cost of debt 1 minus T. So in this issue here, they give you your WACC. You can use this method to count your cost of equity. The weightage of equity is 1 out of 2.5 plus 1.5 out of 2.5 for your debt. Cost of debt is 0.07. Tax is 1 minus 0.35. Solve these equations, you will get the cost of equity 0.2068 or 20.68%. Very easy, very simple. Okay, this is part A, to find the cost of equity. So they give you WACC, they give you the tax, they give you the cost of equity, the cost of debt, sorry, and also the weightage. So you can calculate your cost of equity easily. So the second part here, it's where the proposition will come in. So part B here, they ask you to find what is Western unlevered cost of equity capital. Okay, unlevered cost of equity capital is your R0. R0, okay, it's sometimes called as unlevered cost of equity capital. Sometimes it will be called as unlevered cost of capital. And it could also be called as required return on assets. These are three different names for R0. Okay, so over here they tell you to count the unlevered cost of equity capital. To find this with your RE, okay, your cost of equity you can use the MM proposition too, MM2 to find this out. Okay, MM2 to find this out. RE equals to unlevered cost of equity capital plus debt to equity multiplied by unlevered cost of equity capital minus cost of debt 1 minus T. Okay. Fill in. Okay, fill in the RE just now. Okay, 0.2068. 0.2068 equals to R0 plus debt to equity ratio given to you in this question 1.5 R0 minus 0.07 1 minus 0.35. Expand this equation slowly. 0.2068 equals to R0 plus 1.5 RO minus 1.5 multiplied by 0.07, 0.105 times 0.65. Expand further. $1.975 if I'm not mistaken. 1.5 multiplied by 0.65 is 0.975 minus 0.105 multiplied by 0.65, 0.06825. Shift it over, you should be getting 1.975 R0 equals to 0.2608 plus. You get 0.27507. So the R0 is equals to 0.1392 or 13.92%. So this question is not hard. The only confusing part is usually students make the expansion wrongly here. Okay, so pay close attention on how to expand it correctly and you will get the final answer easily, 13.92%. Okay. All right. So moving on to the following question here on part C, they tell you what would the cost of equity be. So they want you to find the cost of equity if your debt to equity ratio changed. Debt to equity ratio changed to 2, changed to 1, and changed to 0. Okay, change to 2, change to 1, change to 0. So all of these, you use the same MM proposition equation. 2, 1, or 0. Use the MM proposition. MM2. Okay, the RE equals to R0 plus TE R0 minus RB times 1 minus T. So repeat it. For the first one, debt to equity ratio at 2. So RE, use back this one, 0.1392 plus debt to equity is 2 minus the debt is 0.07. So find the answer. 0.2293. 22.93%. Okay. Repeat this question when your debt to equity ratio is 1. Okay. 0.1392 plus 1 just change the debt to equity, so other things all remain the same. 0.1842 or 18.42%. And lastly, change it to 0. 0 is the easiest. 0 multiplied with whatever is going to be 0. So it's just going to be 13.92. That's it. The cost of equity will be changed whenever the debt to equity is changed. Again, based on the MM proposition. So you can see it's very simply done just because you just change the debt to equity. The last one, when the debt is 0, RE is equals to your RO. Okay, remember this. When debt is 0, cost of equity is equals to your required rate of return of your assets, and they are equals to your WACC. Okay, remember this when there's no debt. All right, simple. If you don't believe me, why is it like that? This one already proven. RE is equals to R0. So how do you prove that RE is equal to WACC? So if you look at WACC formula, weightage equity, cost of equity, weightage debt, cost of debt, 1 minus T. So imagine if there's no debt, 0 debt, that means your weightage on your cost of equity is 1. 1 times cost of equity plus 0 debt. So isn't this WACC equals to cost of equity? Okay, so this proven WACC equals to cost of equity. This proven cost of equity equals to R0. So in the end, they are equal if there is no debt. Okay, so far, anyone having any difficulty understanding or not? Are you okay? Can follow, cannot follow? Come, let me know. Can follow. Okay, thank you, Lynn, for responding. As usual, my most actively participating students. Okay, so let's move on to 13 now. Okay, 13. So actually today's tutorial is very, very simple, very easy to follow. All right, so 13, Shallow Corp has no debt. They got no debt, but they can borrow at 8%. So the cost of debt, the cost of debt is 0.08. The firm's WACC is currently 11%, and the tax is 0.35. These are the information given to you on question number 13. So the first question they ask you, A, what is Shadow Corp's cost of equity? So the first question itself, they want you to find your cost of equity. So from the look of here, okay, there's no debt. They tell you this question, there's no debt. So no debt means RE equals to RO equals to WACC, which is equals to 0.11, which is equals to 11%. Okay, because there's no debt. No debt, you can apply this. Simple, easily done. Okay, I just explained to you just now. So it's just 11%. Okay, so let's look at B now. B tell you if the firm converts it to 25% debt, what will it cost of equity be? So they want you to find your cost of equity when now you have new DE ratios. So your debt is 0.25. Your equity is 0.75. So how do you find this? Use the MM proposition 2. Okay, the RE equals to your required return of assets, which is here 0.11. Okay, plus your new DE minus your cost of debt 1 minus T. So find out your RE by replacing 1 by 1. So this is 0.11. Your debt is 0.25. Your equity is 0.75. 0.11 minus your cost of debt here. You say it's at 8%. You can borrow at 8%. 1 minus your T, 35. Okay. So this will give you your cost of equity for B, 0.1165. or 11.65%. All right, this is FEN, your debt is 0.25. Okay, this is for B. So when you go to C, they tell you, what if now I change my debt to 0.5? So my equity also becomes 0.5. So my RE will change now. Everything remain the same. Only my RE will be different and the delta DE will be different. R0 is still the same, 0.11. Plus your new RE is your new DE is 0.5 divided by 0.5, 0.11. All these are still the same. Okay, all these are still the same. So they will give you a 0.1295 or 12.95%. That is your cost of equity when you change the DE ratios, when you change the capital structure. From 100% just now, which is 11% of cost of equity, to 25% debt, 75% equity, now to 50-50. Okay, so there's a changes on your cost of equity now. So the last part section here, it's they ask you to find the WACC for part B and part C. So to find WACC of part B, which is debt is equal to 0.25, okay? So the equity will be 0.75 lah. And then multiply by the equity here, 0.1165. Okay, 0.1165 plus 0.25 on debt, 1 minus 0.35. You can get your WACC easily. Okay, 0.1004 or 10.04%. Okay, next one is find the WACC for the debt equals to 0.5. So this one you change the percentage here. 0.5 of this cost of equity. The debt is still the same. And the tax is also the same. So this will give you 0.0908 or 9.08%. Okay, done. This is how you answer the question. Okay, but when you see here, this is further explanation now. There's extra explanation from my side. So if you realize, okay, when the debt is at 25%, is 10.04% of your required rate of return. So WACC is costing you 10%. But when it's 50-50, your WACC dropped to 9%. Okay, one of the reasons for this drop, very simple. As you have increasing combination of your portfolio consists of more debt, which is cheaper compared to your equity. That's why your cost of capital also dropped. Again, you can see, right? Okay, this is to refresh back about your old understanding of the theory. Yeah? So you can see that the WACC decreased from 25% debt to 50% debt is because your debt is cheaper compared to your equity. Okay, so your effective cost of debt also you don't know yet. The effective cost of debt also you haven't calculated. This is just the pre-tax. The pre-tax itself is already lower. So after deducting the tax, it will be lower some more. Okay. Yep. This is for question number 12 just now. 13, sorry, question number 13. Okay, so it's quite simple, all right, quite easy. All right, so we move on to something more challenging. Okay, long case question. All right, let's look at the long case question. So you see question 16 here. They're telling you there are two different firms, a levered incorporation and an unlevered incorporation. So when you see a levered incorporation, that means this company is a combination of debt and equity. All right. So here they're telling you levered incorporation and unlevered incorporation are identical in every way except their capital structure. They are equally same. Okay, only in capital structure difference. So each company expect to earn $29 million before interest per year in perpetuity. That means this is compounded yearly lah, perpetuity. When each company distributing all its earning as dividends, so no retained earning. All the money gain will be given back to the shareholder, okay, on the bondholders and paying off the debts. But these two company here, one got debt, one no debt lah. So the levered perpetual debt has a market value $91 million and cost 8% per year. So the levered one, okay, the company with the leverage with debt are having a $91 million debt. That's what it means. So now they separate the information here. The levered firm has 2.3 million outstanding shares, and each share is worth 105. Whereas the unlevered firm are having 4.5 million shares, and each share is worth $80. Okay, so neither of the firm pay taxes, so no taxes are taken into consideration. So they're asking you to make a decision. Is a levered stock a better buy than an unlevered stock? So which stock will be a better option? So look at this. I already put in the information here. This is on the equity. This is only on equity. Yeah? You never see the debt yet. Okay? All right. So let's look at unlevered first. Unlevered means the whole value of the company, the whole value of the unlevered company will be just equity because no debt. So the value of the firm will be 4.5 million multiplied by 80. So the unlevered firm is worth $360 million. Okay? All right. Okay? So based on the Proposition 1, Proposition 1, what they tell you? Proposition 1, they tell you that VL equals to VU. VL equals to VU. All right? Okay? So it's supposed to be equal. But we see whether the value is equal or not now. All right, let's look at the levered firm. The levered firm is this amount, okay, for their equity. Now we count the levered firm. The levered firm supposed to be equity of levered plus borrowing plus debt. So let's find the equity of the levered. Okay, the equity of the levered. Equity of levered, that means the equity section of the levered firm is the balance amount just now, 2.3 million, multiplied by 105. So this gives you an amount of 241,500,000. So by right, the balance will be your debt to equalize into $360 million. But according to the information, the debt of this firm is only $91 million. Okay, $91 million. So your value of this levered firm is only 241,500,000 plus 91 million. Okay, this will give you a value of 332,500,000. So from here, you can see that your value of your levered firm is not the same as the value of your unlevered firm. How much difference here? Your value of your levered firm is undervalued by $27.5 million. Okay, so 332,500 not equals to the same of 360 million. So it's not same. So this is undervalued compared to this. By right, they're supposed to be equal valued. So in this case, when something is undervalued, you know which one to buy already. So what you should do now is buy the levered firm stocks, because they are underlevered. Sorry, they are undervalued. They by right supposed to be valued equally the same as a unlevered firm. But from here, the problem here is it's underlevered, undervalued by 27.5 million. So there are 27.5 million opportunity for it to grow. So of course, in that case, you're supposed to buy the levered firm stocks. Okay, can follow, cannot follow? Are you all right? I want to hear. No response on chat box. Still good. Okay.
So,
Yes.
so we have to do the levered and unlevered value, is it? To compare whether the value of the amount is like which one is higher and which one provides the
No. You don't compare which one is higher. You need to compare which one is undervalued, because based on the MM proposition, you supposed to find out that VU is equal to VL.
Okay.
Unlevered and levered supposed to have the same equal value. But
Okay.
over here in this case, they ask you which firm will be a better investment, levered or
Okay.
unlevered. So you find out that the levered firm is undervalued. It's not $360 million.
Okay.
So if that's the case, you should buy the levered firm stocks. That means their market value is not high enough. They haven't go up to 360 million yet.
Okay. Get it. Thank you so much, sir.
All right. I use earning per shares to compare. Cannot. Okay, cannot. Because this question, they ask you to use levered and unlevered firm. That means you're using the MM proposition. Okay, you say EPS is another way to look at this. All right, earning per shares on the to compare on the comparison. But then earning per shares is only taking into consideration of equity. They never look at the debt. Okay, they never look at the bondholders. Yeah, so it's not accurate in this sense. Kylie? Got it? Yeah, okay, clear. All right, so I guess you all get it now, okay? This is based on the MM proposition. MM proposition is a statement lah. So the statement says that your value of a levered firm is supposed to be equal to unlevered firm. So from this, we find out that the levered firm is undervalued. When it's undervalued, you know the potential for it. They should be this value. So they got the potential to grow. So buy the undervalued company, the undervalued company now, of course. Okay, buy their stocks because it's undervalued. Okay, the more you buy, you push up the demand. You push up the demand for it, then the supply will be more limited. The market value of the stocks will goes up, and then eventually it will reach back to $360 million. And when they balance there, it will be staying stagnant there, not much of movement anymore because it reaches original value. Okay, yeah. So now we will go to the second part of the tutorial, which is talking more on the MM proposition 1. Just now we talked about MM proposition 2. Okay, so MM proposition 1, more in depth here, we'll be talking about the VL equals to VU plus tax multiplied by borrowing. Okay, just now we're just talking about basic, don't have the tax at the back there. Okay, so when you take this into consideration of tax inside here, all right, VU could also be written as this. EBIT multiplied by 1 minus T divided by RO, your required rate of return on assets, or your unlevered cost of equity. Okay, your VU could be written like this, or it could be written like this also, net income divided by R0. Okay, so your VL now will be EBIT 1 minus T divided by R0 plus tax multiplied by borrowing, or net income divided by RO plus tax multiplied by borrowing. Okay, this is your MM proposition 1 with taxes. So let's look at question number 1 here. Janita Corp has an EBIT rate. They tell you the EBIT rate of $975,000 per year. That is expected to continue in perpetuity. That means it will be compounded. The unlevered cost of equity, I told you just now, which is your R0, it's 14%. The corporate tax is 35%. The company has a perpetual bond issue outstanding with a market value. So bond is your borrowing. Bond is your debt. Your debt here is $1.9 million. Then they ask you, what is the value of the company? So find the value of the levered company. So they're given to you the EBIT already, So 975,000. 1 minus 0.35. 0.14 plus 0.35 times with your borrowing or your debt. So your value of your firm is 5,191,785 and 71 cents. This is the value of your firm. So simple. Okay, they give you all the information, you just fill in, you find your value of your firm. 5.19 million. Okay. After counting this, part B, they're asking you a very scenario-based question. The CFO of the company informs the company president that the value of the company is 4.8 million. So is the CFO correct or not? So this CFO go and tell the boss. Okay, instead of telling 5.19 million, he says 4.8 million. So is it correct or not? A lot of people will assume that this is wrong. Okay, we calculated is 5.19. You tell 4.8 million, you undervalue it by 300,000. Okay, that's no good. That's not fair. That's cheating and blah, blah, blah. So the problem here is he's not wrong. The CFO may be correct. Why the answer here is may be correct? Okay, the CFO may be correct. Only maybe, you know, not confirm correct, maybe. Why? Because the value calculated here does not include, sorry, the value here included, all right, the cost of any non-marketed claim. So all these are included here. Okay, this 5.2 million included all the costs on any non-marketed claim. So this non-marketed claim is including agency costs, including the bankruptcy costs, and also the other risks. All right, so maybe the CFO report 4.8 million is after he weighing all these issues. All right, that's why it's a maybe. It's not confirmed. Unless more information like being given to you, the CFO announced that it's 4.8 million after excluding all the other marketed claim costing. So that one might be more accurate. But if it's not stated, he may be correct on it. Okay? We don't know. It's very vague now. We don't know whether he really purposely announced it 4.8 million wrongly or he really calculated the marketed claim also. Okay, so the answer to this question is maybe only. Okay, he's maybe correct only. All right, I hope that give you a better idea, okay, on explaining this. But giving the value of the firm is so simple. It's very straightforward, very simple. Okay, so going to the final question here is a case study. So I hope that you guys follow me closely. This case study is actually very simple, but it's very lengthy, and you might feel very confusing halfway through. So let's follow me closely, listen to me carefully. Okay, so let me read the case to you, and then at the same time, we will analyze it. So Steinberg Corporation and Dietrich Corporation are identical firms, except that Dietrich is more levered. So both are the same, just that there's one of them taking more debts. All right, so Dietrich is more levered, much more, they take more debts in conclusion. So both companies will remain in business for 1 more year. That means they will stay in the business for 1 more extra year. The company economists agree that the probability of the continuation of the current expansions is 80% for the next year. And the probability of recession is 20%. So both of these companies going to be inside the business for another year. There are an 80% chance of expansion and 20% chance of going into recession. Okay, so if the expansions continue, each firm will generate the EBIT of 2.7 million. So if expansion successfully, each firm will get $2.7 million. Okay, but if a recession occur, each firm will get a profit of only $1.1 million. That's the story here. Steinberg debt obligation requires the firm to pay 900,000. So you have 2 companies. One is Steinberg. One is Dietrich. So Stenberg debt or bondholder, okay, is 900,000 at the end of the year. Irregardless lah, they need to pay this $900,000. 900,000. Yes, extra zero, 900,000. Okay, Stenberg must pay 900,000. Debt, bondholder. Bondholder have more rights than shareholder. So you need to pay your debt first, then only your shareholder can get the money. Okay. Dietrich debt obligation requires the firm to pay 1.2 million. So Dietrich debt is 1.2 million. Neither firm pay taxes. Assume the discount rate is 13%. Discount rate is 13%. Okay. A. What is the value today of Stenberg's debt and equity? What about for Dietrich? Okay, so let's answer A first. Okay, let's answer A first. So you see, they want you to find out the total debt and equity, probability of it happening 1 year later. So you don't know, there's an 80% chance of expansion and 20% chance of recession. So you need to calculate what is the value. Okay, what is the firm's equity and debt. So under Stenberg, look at Stenberg here. Okay, Stenberg, we look at his equity first. Stenberg's equity, there's two potential. Two potential on Stenberg equity. One, if it's on the expansion, so 0.8 out of 2.7 million, you need to pay off your debt first, minus 900,000. Okay, so this is situation number one. All right, 0.8. So there's a chance of you having, how much is this? 1.8 million. There's a chance of them having a 1.8 million. Okay. Scenario 2, 0.2% chance. Okay, 0.2 chance or 20% chance of it having 1.1 million. Deducting the debt, so you're left with 200K lah, basically. Okay, so 0.2 multiplied by 200K. So these two scenarios here. So 1 year later, this is the two probability. So we're going to count the equity of Stenberg now. Okay, 0.8 chances of you taking 1.8 million and 0.2 chances, okay, or 20% chances of you only getting 200K as stockholders, yes, shareholders. Discounted by 1 plus discounted rate power of 1 for 1 year. Okay, 1 plus 0.13 power of 1. So this will give you the equity of Stenberg. Okay, don't cross the line to there. The equity of Stenberg is actually 1,309,735. This is their equity. Okay, for their debt is simple. Debt for Stenberg, simple, 0.8 chance of 900,000 plus 0.2 chance of 900,000. Either way, it's still 900,000. So discounted by 1 plus R power of 1. So the debt for Stenberg will be 796,460. This is the equity, this is the debt. So repeat this section for Dietrich. So Dietrich also got two scenario. So the equity, okay, scenario 1, 0.8 out of 2.7 million minus 1.2 million. So 0.8 out of 1.5 million. Scenario 2, 20% chance of them only getting 1.1 million. So you pay all his debt, maximum can pay until 1.1 million only. So in the end, 0 go to the shareholder, nothing. Cannot even finish paying your debt. So 0 lah. All right. So here you can count your equity of Dietrich. Equity of Dietrich, all right, is 0.8 multiplied by 1.5 million plus 0.2 multiplied of 0 divided by 1 plus 0.13 power of 1. So equity of Dietrich will give you 1,061,947. So do the same thing for debt. Debt of Dietrich, okay, 0.1, 0.8 multiplied by how much? 1.2 million. And then this one you cannot pay full, you only can pay 1.1 million. Okay, divided by 1 plus 0.13 power of 1. So the debt of Dietrich is 1,044,248. So this is basically what you need to find out for these two companies. Okay, for these two companies, you need to find the equity, you need to find the debt. You got it. This is part A. Okay, the problem comes in part B now. Second part of the questions. So Steinberg CEO recently stated that Steinberg value, okay, Steinberg CEO say the company value should be higher than Dietrich because the firm has less debt and therefore less bankruptcy risk. So he is saying that we got less debt, we got 900,000 debt money. So there's chances of first bankruptcy is lower. Okay, so do you agree or disagree with this statement? So first of all, when this statement come out, okay, you need to count the value of both company first. Okay, so the value of both company, how do you count? Value of Steinberg is equals to 1,309,735 plus 796,460. Value of Dietrich is 1,061,947 plus 1,044,248. So both of them are having the same value. So both company are having same value, 2,106,195. Okay, so the CEO say the risk of bankruptcy will be according to the debt. So no, okay, it's not according to the debt amount. Okay, the risk of bankruptcy will not affect the firm value. All right, the actual cost of bankruptcy, okay, is the one that decreased the value of a firm. All right, so the cost of bankruptcy. So you need to take into consideration of cost of bankruptcy. So based on the statement from the CEO, we disagree. Okay, we disagree. Because you want to talk about bankruptcy, you need to look at the cost of bankruptcy. So there are other factors that are affecting it. But in this problem, they did not tell you anything regarding the cost of bankruptcy. So when there's no cost of bankruptcy, you cannot judge them according to that only. Okay, there are a lot of factors that determine whether a company can do well or not. So there's a cost of bankruptcy. All right, but in this case, they did not take into consideration of bankruptcy costs. So the statement by the CEO could not be accepted. You disagree with it. All right, and this wrap up the final section of today.